It's not the market that ruins most trading accounts, it's the trader. What's the difference between surviving in the market and blowing up your account? In my humble opinion, it's usually about avoiding the common mistakes I'm going over today. These are the same mistakes I saw clients making again and again during my time working on Wall Street and in the city. And I hold my hands up, I've made pretty much all of these myself.
Did I do that?
And frankly, you're going to make some of these. It's inevitable. Maybe you already did. But the sooner you recognize them, the sooner you can fix them. Hi guys, I'm Jasper, market analyst for WeTrade and founder of Trading Writers, and I'm here to help improve your trading education. Before we dive in, a quick but important disclaimer. This video is produced for educational purposes only and does not constitute investment advice, a recommendation, or a solicitation to buy or sell any financial instruments. Trading CFDs and Forex involves significant risk of loss and may not be suitable for all investors. You may lose all your invested capital. Ensure you fully understand the risks and seek independent advice if necessary. A CFD trader using maximum leverage is like being handed the keys to a Ferrari after your first driving lesson. I think you get it, but just to be clear, the chances of a crash are big. First thing to mention, on the trading platform, you can actually see your leverage in real time. Just look at the trade tab at the bottom of the platform. There's a column showing your margin level. And what does an over-leveraged trading account look like? Based on my experience, it usually looks something a bit like this. Let's say you've got $2,000 in your account with 1,000 to 1 leverage, and you open two standard lot positions, one in euro dollar, one in pound dollar. Your required margin is just $200 in total, leaving you with $1,800 in free margin. That feels like a lot of space, but really it isn't. Because you're trading two standard lots, every pip costs you $20. So if the market moves just 90 pips against both trades combined, you get hit with $1,800 in floating losses. That's your entire free margin gone. Even if your stop loss is 100 pips away, you'll never reach it. Your trades will be liquidated before the trade has even had a chance to recover. The main solution to this mistake is having a plan, and I'll get to that in a minute. Too many trades will kill you, just as sure as none at all. That was my very poor Freddie Mercury impression, reworded for traders. Here's Queen doing a much better job of it this time. Overtrading is taking too many trades. Moreover, it's taking too many of the wrong ones. There are a couple of reasons people fall into this trap. The first is overconfidence. You think, I'm in the zone, so you start firing off trades like confetti. The second is not having a clear plan or having one but not sticking to it. You jump in whenever something looks vaguely interesting. I don't think it's possible to fully resolve this, but what I do now is grade each trade setup as A, B, or C. A grade trades are clean, high probability, everything lines up trades, and I try to only take those. Then every so often, I'll go back and review, were the B and C trades actually worth taking? Sometimes they surprise me, most of the time they just remind me to wait for the good stuff. The trading platform makes it easy to track this, by the way. Just open your account history tab and review your trades. Were they A grade? Were they rushed? Were you even awake? Overtrading is often about not filtering. You can be active, especially if you're a day trader, but just be selective. Ah yes, revenge trading. The trading equivalent of texting your ex and pretending it was by accident. It usually goes like this. You take a loss, maybe it was unlucky, maybe it was just a bad trade. And something in your brain says, right, I'll get that back. Next trade, double size, let's go. The problem is you're no longer focused on what the market's doing. You're focused on fixing your own frustration. It's not about setups anymore, it's about score settling. And those trades are rarely well thought out. You skip the plan, ignore the risk, and click the button. And you do it because you want to feel better. Spoiler, it doesn't work. When I was working as a relationship manager at one broker, I could see the spikes in volume right after a client had a string of losses. The string of losses happens in trading. Sometimes your strategy is just out of sync with the market. How you respond to that emotionally, though, can be a major difference maker to your P&L. So what's the fix? I do this. And if you read the Markets Wizard books, a lot of the best traders do this too. Step away. Don't click anything. Don't look for a new trade immediately. Go make a cup of tea. Write down what went wrong. Let your brain cool off before you start analyzing the next opportunity. Impulsive trades, the ones you take without a plan, without a signal, and sometimes without even really knowing why. You just see a candle spike or a price moving fast and think, right, I'm not missing this one. Next thing you know, you're in a trade based on entirely the fear of missing out, FOMO, rather than anything logical. I've seen it time and time again. I've done it myself. In fact, back when I was sitting in on strategy meetings and one city broker, one of the senior guys had a name for it: chasing shadows. The problem, these trades usually don't come with a proper stop loss or any target in mind. You're just hoping it keeps going, and when it doesn't, when it stalls or it reverses, you're stuck wondering why you even entered the trade in the first place, let alone what you should do next. Here's the fix. If you can't explain your trade in one sentence, clearly and confidently, don't take it. That's my personal rule. Something like, I'm going long because the trend is up, price broke above resistance, retested it, and now we've got a bullish engulfing candlestick with strong volume. That's a trade. The trading platform won't stop you placing a bad trade, but if you are prone to FOMO, try removing the one-click buy-sell buttons from the chart. But mainly it's on you to slow it down. Take a breath, ask yourself, is this my setup or is this just adrenaline? The opposite of impulse trading, but just as frustrating, is trigger shyness. It's when you've done the analysis, you've spotted the setup, everything lines up, but when it's time to actually place the trade, you freeze, you hesitate. You think, maybe there's something I'm missing, or I'll just wait for a bit more confirmation. And by the time you talk yourself around, the move's halfway down, and you're chasing it. Don't beat yourself up over this. You don't need to toughen up or stop being a wimp or anything else you might have told yourself. This still happens to me after a few losing trades. It's actually logical if you think about it. Your brain is questioning if you're doing the right thing. What you need is a way to explain to your brain that you've done the research on this and it's going to work out eventually. This is done in two ways. One, if you have a profitable track record, you go through your past trades where it worked. Two, if you don't have a profitable track record of live trades, then go through the chart and back test your strategy again. Trigger shyness is just a manifestation of fear. Fear of being wrong. Fear of taking another loss. But ironically, not taking your planned trades is how you lose your confidence. You have to trust your process. Okay, halfway through, if you're getting some value from this video, I'd be grateful if you could just drop a quick thumbs up. It really helps. Picture this. You're doing everything right. You took two trades with a 2-to-1 risk reward ratio. One was a loss, but the other was a profit. That should mean you're net profitable because the profit was twice as big as the loss. But somehow you're in a net loss. That can happen when you do something like this. Trade one lot of Eurodollar worth 100,000, then one lot of gold worth 100 ounces, which is worth around 300,000 at the time of recording. Both are trading one lot, but one is trading 3 times as big as the other. Or it can even be something like this. you trade one lot of Eurodollar with a stop loss of 20 pips and a risk of $20. And then on the next one, you trade one lot of Eurodollar with a stop of 50 pips and a $50 risk. Your risk more than doubles from one trade to the next. When your position size varies randomly, your whole edge falls apart and you can't track performance properly over time. Here's my fix. Use a fixed percentage risk per trade. The implications of this is that you need to trade a different number of contracts for different trades so that the amount you're risking and profiting is always about the same. There are plenty of position size calculators online, or you can set it manually in the platform. Let's start with stop loss mistake numero uno. Not using a stop loss at all. I do get why people do this, and for years I've made it my job to explain why you do need a stop. I do get that stops get hit and then the market turns around and hits your take profit. That is annoying. But the reason you have a stop is for the times that the market doesn't turn around and just keeps going against you. And I've got proof on this. I've seen enough trader performance stats and was the most common mistake among blown up accounts. Then there's the too tight stop traders who set 10 to 15 pips on a volatile forex pair like pound yen and then wonder why they keep getting stopped out. The market isn't targeting your stop, it's just moving the way it always does, and your stop is sitting right in the middle of the noise when it should be allowing for the noise. And then there's the classic moving the stop loss mid-trade. We've all done it. You place the trade, it moves against you, and instead of cutting it, you give it a bit more room. And then a bit more, then suddenly the trade's well in the red and you're still hanging on, hoping something that magical will happen. Here's the rule of thumb. You can move your stop tighter, but never wider. Just take the loss and reassess. Taking profits too early on a trade is just as bad as moving your stop loss. I'm serious. Doing this kills any chance you have of consistently profitable trading. You've placed a solid trade, price moves in your favor, and then that little voice creeps in. Don't let it turn around, just take the win. So you close it for a tiny gain, maybe 10, 15 pips, even though your original plan had 50 on the table. And of course, what happens? Price carries on exactly as you expected. You're left watching the chart, wishing you just left it alone. Don't you beat yourself up over this. Pretty much everyone does this to start, but successful traders have to fix it. I used to do this, especially if I just had a few losing trades in a row. Suddenly, even a small win feels like a victory, and you'll grab it before it disappears. There are a few ways to fix this. Use partial take profit levels where you take profit on part of the trade and then hold the rest. Use trailing stops. In my opinion, the best but hardest way, let the platform do its job. Think of it like this way. If you're always taking small profits but letting your losses hit full stop, your risk to reward is actually upside down. A lot of traders don't actually have a trading plan. Be honest with yourself. Are you one of them? I don't mean a vague idea like buy low, sell high. I mean a proper, written out, rules-based approach. What defines your setup? What confirms your entry? Where do you exit? How much do you risk? Most people haven't thought that far, and that's a real issue. Strategy hopping is just what happens next. Without a clear plan, you've got nothing solid to stick to. So as soon as you take a few losses, you start looking for the next big thing.
Here in my garage, just bought this new Lamborghini here.
A new indicator, a new YouTube strategy, someone on Telegram saying, this one never fails. You bounce from one idea to the other, never long enough to test if any of them actually work. I've seen this in live trading rooms and talked to many clients about this, and yes, I've done it myself. When I first started out, I had the benefit of working for a prop trading firm based on Wall Street that actually specialized in forex trading. They taught a very simple price action technique using trend lines and trading off news events. I knew other traders were making money, but I still tinkered with it I still change the system, adding RSI confirmations, etc. So even when you have a plan, a few losses makes it very tempting to try new things. The fix is simple but powerful. Commit to one trading plan and stick with it for 20 or 30 trades. Keep a journal, note why you entered, where your stop and target were, how the trade played out. Only after that can you start to see if it's you or the system that needs adjusting. It's your trading account, your money, you make the rules. But that doesn't mean you have to figure it all out from scratch. This is one of the things I would definitely redo if I was starting trading again. Trying to do it all your own, I get it. Trading attracts independent thinkers. You want to think it out for yourself. When I first got into trading properly, I had the advantage of sitting near people who were much more experienced than me, people who traded real size. I didn't make use of that enough. Feedback is worth its weight in gold, but you have plenty of choices these days to find mentors, from live trading rooms to bulletin boards to YouTube content, to following people on social media, to prop trading firms. Now, the flip side, blindly copying someone else's trades without understanding the reasoning, that's not mentorship, that's dependence. You'll never build confidence in your own process if you're just pressing buy because a guru on Telegram said so. The best traders I know, they learn from others, sure, but they adapt it to their own style. They ask questions, they test things, they journal, they keep what works and drop what doesn't. Likewise, keep talking with other traders that offer value and avoid the rest. So if you've got someone who's willing to guide you, brilliant. Just make sure you're still learning to think for yourself. All right, that's 10. Naturally, I couldn't cover them all. What classic trading mistake did I miss? Drop a comment and I'll try and cover it in a future video. Quick request, please smash that like button and subscribe to see more videos like these as soon as they're released. Appreciate you watching, stay disciplined and trade smart.